Welcome to this explainer. Today, we're diving into something massive: the hidden systemic risks currently brewing in the $2.5 trillion private credit market. And our story really begins with a number that, let's be honest, most people completely ignore until it's far too late: the 30-year U.S. Treasury yield. It recently hit its highest level since 2007. Hidden right inside that number is the actual price of money. And for the first time in nearly 2 decades, it is flashing a massive warning sign.
And hey, the United States isn't alone in this. If we look across the globe, the UK's 30-year yield recently climbed to its highest level since 1998.
Meanwhile, Germany's 30-year reached its highest point since 2011, and Japan's, well, it's sitting at an all-time high. When 4 of the largest sovereign bond markets in the entire world start spiking like this all at once, it tells us that the bond market, which is typically the quiet, predictable adult in the room, has officially pulled the plug on the party.
So here is how we're going to uncover this unseen threat today. We'll start with the flashing warning signs, break down bond yields, explore the floating rate trap, look at private credit's first crack, uncover a very sneaky accounting illusion, and finally, face a looming maturity wall.
Part 1. The flashing warning sign.
All right, to understand the coming panic, we kind of have to look beneath the headline numbers and understand why bond yields move in the first place. In its absolute simplest form, a bond is just an IOU, and the relationship between a bond's price and its yield acts exactly like a seesaw. If buyers just aren't interested in buying the debt, the price drops. To attract new buyers, the yield has to go up. Price down, yield up. It's that simple.
Part 2. Bond yields and borrowing costs.
When yields rise across the board like we're seeing, buyers are demanding significantly higher returns before locking up their cash. And this shift is being driven by 4 massive macroeconomic factors. First, the Federal Reserve is raising baseline rates, which forces older bonds to drop in price. Second, inflation. If your dollars are going to be worth less tomorrow, you demand more return up front. Third, pure supply. The U.S. is issuing historic, Costco-sized amounts of new debt. And fourth, demand. Foreign institutions are actually starting to pull back.
Which brings us to Part 3, the floating rate trap. Now you might be thinking the real pain is in those 30-year bonds. Actually, scratch that. The real pain is happening at the short end of the yield curve. And this leads us to SOFR, the Secured Overnight Financing Rate. Think of this as the overnight receipt for the entire U.S. financial system. Back in early 2022, SOFR was effectively sitting at 0. But as the Fed aggressively hiked rates, SOFR skyrocketed to over 5% by mid-2023.
You know, most of us think about debt like a standard fixed-rate mortgage, right? You lock in your rate on day one, and your payment never, ever changes. But the private credit market, it relies almost entirely on floating-rate debt. A corporate borrower's interest rate is directly pegged to SOFR plus a spread. So when SOFR aggressively spikes to 5%, the borrower's interest payments aggressively spike right along with it.
Part 4. Private credit's first crack.
Let's look at a real-world example of what happens when cash flows tighten and this floating rate trap literally slams shut. In 2021, a company called Pluralsight was acquired and they took on over $1 billion in floating rate private credit debt. While SOFR was near 0, the math totally worked. But when SOFR hit 5%, the interest payments became completely unsustainable. It got so bad that by August 2024, lenders were forced to step in, convert their debt, and take 85% equity of the company just to keep it breathing.
The terrifying thing here is that Pluralsight wasn't unique at all. It was just one borrower in a massive stack absorbing the exact same compounding rate shock. And this perfectly illustrates a brilliant warning from JP Morgan CEO Jamie Dimon. When talking about cracks in the credit market, he said, "When you see one cockroach, there are probably more."
And the data absolutely proves this contagion is real. The Fitch private credit default rate recently hit 6% on its trailing 12-month measure. That is literally the highest rate recorded since the index's inception. Defaults are climbing exactly as the math suggests they should be.
Part 5. The sneaky accounting illusion.
So you've got to wonder, if defaults are hitting record highs, how is the broader $2.5 trillion private credit industry acting like everything is totally fine? Well, the answer is a little accounting magic. It's called a payment in kind, or a PIK feature. This essentially lets a struggling borrower avoid making their interest payments in actual cash, which is pretty incredible considering interest is supposed to be the actual cash return a lender earns.
Here's how it plays out.
When a borrower just can't afford those higher cash payments, instead of triggering a default, which would officially stamp the loan as non-performing, the unpaid interest just gets added directly to the loan's principal balance. Technically, not a single cent of cash was paid, but the loan avoids the default trigger entirely and falsely appears on the books as a healthy, performing asset.
But wait, the crucial point here is that it actually gets worse. Many of these loans are held in business development companies, or BDCs. These funds report this unpaid PIK interest as income, and because of regulatory rules, they are legally required to distribute 90% of their taxable income to investors. This means they are physically mailing out actual cash dividends to their investors based on money they never actually collected in cash.
And this illusion, it's spreading like wildfire. 11 to 12% of private credit loans now include these PIK features. That's a massive 72% increase since the end of 2021. Even more alarming, more than 60% of recent Fitch defaults involve these payment-in-kind arrangements. They're essentially slapping a Band-Aid on a bullet wound.
Which leads us to part 6, the looming maturity wall.
Because these private loans don't trade publicly on Wall Street, they rely on subjective internal accounting models. They fall under what's called Level 3 accounting, meaning their value relies entirely on unobservable inputs. But the truth is starting to leak out. MSCI recently found that more than 10% of these illiquid private credit loans are already quietly marked down internally by at least 50 cents on the dollar. The damage is definitely there. It's just being kept off the public radar.
And all of this hidden bad math culminates in a terrifying maturity wall. Between 2026 and 2029, roughly $85 billion in business development company loan maturities are coming due. Sure, you can roll unpaid interest into a bigger principal for a while, but eventually the bill comes due.
So the absolutely critical question you need to take away from this explainer is this. What happens to the broader economy when all of this near-zero debt hits the wall and these struggling companies are forced to refinance that $85 billion at today's punishingly high interest rates? The math is still the math, and bad math doesn't just disappear.